thank Neville Spear, one of your members who invited me here. Neville's been with us and certainly helped our organization on many occasions with trends and deeper understanding of the beef industry. So my hat's off to him. I am the guy that's going to talk about money, and it's something very important to every strategy, every producer, every health specialist, every upstream value-add producer of food and fiber. I'm assuring you, too, that after the end of this presentation, you're neither going to carry me out on a throne, but I hope you don't draw and quarter me and drag me through the streets of Louisville. I am going to speak neither pessimistically nor optimistically, but realistically. And a realistic picture is not very pretty, and not getting any prettier. So, a little time for soberness, I suppose. Let me just tell you who I am first of all. This is who we are. Farm Credit of Mid-America serves these 4 states. And we serve farmers, we serve rural residents, and we serve upstream value-added producers. We have some very large loans to people producing milk, poultry, other livestock-related products, both in those 4 states and both around the United States through our charters. So we're not just a little homegrown serving the farmer-only type industry anymore. We have at least $4 billion outstanding to those value-added food companies. Our customers total around 86,000, and that $16 billion is in all types of loans. Our marketplace is very diverse. It's typified by small farmers. And certainly animals, livestock, meat, protein is a very large piece of that. I think that there's at least in cattle alone 14% other livestock, which would be poultry, pork, certainly new emergent livestock. We have goat producers and others. Dairy continues to be a big, one of our 4 states, I think, attributes is that we're very diversified. I can look at my farm credit brethren in Wisconsin, and how often we talk about portfolio diversification. It's good not to have all dairy loans sometimes when dairy's in the slump. But then let me tell you about my friends, the nails here. I think the nails typify what happened in the last 6 to 8 months. And then I heard a loud bang, and when I turned back, she was gone. That was our economy, folks. What happened in the last 6 to 8 months? Gosh, do you realize in the last 6 to 8 months, going up through June, our company was hitting a record growth level. We were growing our business 21%. We saw expansion in almost every form of our business. Heavy demand for capital everywhere. Corn prices hit record levels of $7.50 last summer. So did other commodities, wheat, soybeans, almost everything. But at the same time you saw those prices, then what happened in your industries and livestock? Terrible pressures and struggles. Feed prices soaring through the roof. Poultry people hitting it first. Also hogs and cattle. Anybody had to feed that $7.50 corn suddenly realized they had a new reality. And then the U.S. economy, unbelievably or not, was clicking along about a 3% growth rate just last summer. And then overnight, bam, gasoline was $4, wasn't it? We were chasing that. As my son said recently, Dad, remember the good old days when we had Circuit City stores? Fast change happening all about. Here's a map that shows us some of these pressures. I'm just going to show you some pictures. I'm a visual learner, and I like to see pictures. Here's what the problem is. Those 2 red dots on the end, that's the definition of a recession. 2 consecutive quarters of negative growth. And that's indeed what we've had. Now, when they project this, just in the next few days, you're going to see that go even lower. In fact, I'd have to modify this map because that's going to go at least to negative 6% and possibly lower. That has some real questions for us in terms of the impact there. You can see the 4th quarter average in the blue line. That's also going to dip appreciably below the negative. Here's one of the problems. Anytime things change so fast, so quickly, it creates profound issues for us. Look at the blue line there. That's inflation rate all items considered. That red line is inflation discounting food and energy prices. I often wonder why economists track inflation discounting food and energy prices. Just to maybe make it look better, huh? I don't know. But what we see here is a precipitous rise and then fall of energy prices just about triggered a lot of tumult and a lot of change. That dropping line was one of the fast. I borrowed these slides, and I should give him credit, Dr. Larry DeBoer at Purdue. That's one of the fastest times that line has dropped so appreciably in such a fast period. Now, if you generally talk about inflation and dropping inflation, that would generally be a good thing. But not when it throws your economy into a total chaotic. Now, at last, here we have a line going up. Unfortunately, the wrong one. Unfortunately, the wrong one. And I'll tie this one to the one we saw earlier. First of all, this line, when they project it next month, is also going to continue to rise. In fact, did you know it takes 3% positive GDP growth in the United States to keep unemployment at an even level? So we're going to be looking at 6%. That's why the economists are projecting double-digit unemployment to come. Things are going to get worse before they get better. I also say, Dr. DeBoer says, this rise in unemployment is one of the fastest rises in the history of the United States. It's not the highest, but it occurred over one of the sharpest and closest periods of time. Now everybody says, well, are we in a depression? No, this is not the Great Depression. In 1920s and 30s, when the Great Depression happened, unemployment was 25% and gross domestic product was negative 35%. We're a long way from that. But there are also no positive trends yet. Let's look at another map, and this has become the poster boy of the current economic problems in the United States. The match that set everything off was the collapse of the subprime mortgage market. But here's a 100-year chart. I mean, anytime you can track something over 100 years is pretty profound. This shows the relationship between home prices and values versus wages, and I'm not going to get into the technical detail of this chart. But what happened in this country, you can see it beginning in the year 2000 there, you had a precipitous and unrealistic value in real estate. Just surging prices, East Coast, West Coast, we've all read that, Arizona, California, New York, condominiums in Florida. A lady I knew in town here was going to Florida every week. She was a realtor. She was buying unfinished condominiums down there for $600,000 and flipping them to new buyers for over $1 million. That doesn't go on today. But here's the bad news in this chart. Look at the 100-year relationship and where the red line kind of averages out. The red line suggests we haven't seen the end of it. In fact, although the Board of Realtors has commercials on and would like to speak to us with optimism, it ain't going to happen yet. There's some pain to come still as this thing values out, and every day you can read headlines in the story about what are we going to do with these toxic assets, and they're still a burden on our system, dragging us down. It's going to continue for a while. Residential building permits, another sign of economy. One of the sharpest. Now, this map is bad if you're trying to sell a home or sell a lot or do something. But this map is disastrous if you're a home builder. Look at that. Let's look at one more chart here in terms of the stimulus in the economy. Look at how low the residential line there is, but look at the business line. That's even more scary. The investment of capital growth and new business and surging is not there, and it's going lower. So there's rocky times ahead. There's times too. I gave this presentation to a group of farmers the other day, and I said my underlying theme here is one thing: in times of danger, manage risk. Manage risk. I think it's a lesson for all of us, and we'll talk about that in a minute. Here's one that speaks to livestock producers and to farmers and to all of you and your companies. And this is like that gentleman said, a perfect storm. There are two factors here competing and tying into one another. Neither of them is very bright. First off, you track the line of things that we're buying, imports. We've stopped buying things from China to a degree. What does that do to China? Causes a recession within their economy. We've also stopped selling things. And the United States sells two things these days. They sell technology and they sell agricultural products. But they don't sell them to people whose cash is drying up. So what you see there is a real challenge for meat producers and others selling chicken, whatever, beef, other products overseas. Trends aren't good. So, what is this? And what's the impact to capital, to the farming industry as a whole, to the businesses that you serve? Well, this is one of the byproducts of that. First of all, you've seen a real shakiness in financial markets, and that's led to premium pricing, and in fact, all industries raising private capital are subject to this. Now, we're a GSE, and I have to be specific, a GSE, a government-sponsored entity. In a sense, we're like Fannie Mae or Freddie Mac. Farm Credit is a GSE. Fortunately, we don't have Fannie Mae or Freddie Mac's problems. We don't have any of those problems like that. Even in our rural housing sector, our credits are very good. We have less than a 2% delinquency rate because we made loans to people that had equity. It's an old concept. But this chart shows that anybody, and I see the next speaker is John Deere, and he'll know this very well. He's raising private capital too, and it's costing all of us more because of the uncertainty. There's also going to be a pig at the trough phenomenon, and the pig at the trough is going to be your federal government. Let me talk about that a little bit here in a minute. This is the process of which capital is raised. It goes from farm credit and worldwide investors back down to the farm. On the far right end, you see national or global investors. In fact, 8 to 10 months ago, the Chinese were buying up to 42% of our farm credit bonds issued every day. Wasn't a bad thing necessarily. Kept the flow of money to American agriculture going. Kept the flow of money into America, period. But the Chinese have virtually disappeared. They're no longer at the table buying U.S. bonds. They're certainly not buying you farm credit bonds. Neither are many other institutional investors, because there's a hunker down mentality right now. And that's what's caused the credit freeze, if you will. This pattern here on the table got terribly disrupted. And in September and October, it was very, very scary to us. Before in our history, we've never lacked to have more bond investors out there than we could actually issue bonds to. Then suddenly, almost overnight, they were gone. And that made us scratch our heads. So let's talk about if there's any positive signs. Well, right now, we're still suffering through a period where it costs more to borrow money. There's uncertainty, and there's this put your funds in a mattress attitude. There's still that. Banks are sitting on tremendous amounts of assets, and they're not lending much. Generally, I'm not bad-mouthing banks, but that's where they are. And there's all sorts of issues with us in terms of both structures, terms, maturities, conditions for capital. And the good news is since January, we've actually seen improvement, but we're not out of the woods yet. In fact, the good thing that we've been able to do, folks, we will issue debt from 30 days to 30 years every day of the week. We have a full pricing line up, and whether you're a private farmer with us or you're a very large ag producing company, we have all sorts of terms for you. And we have not had to shut the door on any one of those kinds of things through all this tumult. But one of the things I made mention to earlier was a fear that the supply of government will overwhelm the market, leading to higher rates in the long term is very, very real. The government can't write all these checks without having somebody to buy that debt. If the government overwhelms the market, then anybody else raising any kind of private capital is going to have to pay more for it. And that's an impact on all of us. So we'll see how that comes out. A lot of stories to be played. Now, what's the effect on farmers? For the short term, things are not, in a way, there's some optimism here. There's some good byproducts because short-term rates are low and they're projected to stay low. There's attractive midterm rates for borrowing. And there's more volatility in the longer-term rate market. There is more restrictive lending by banks. Many will not lend longer than 5 years. A farmer looking for a real estate, he only has one option, 3 or 5 year adjustable, roll it over, refinance when that comes due. Because banks cannot fund long in the same way that farm credit. We have access to longer term bonds, at least we did. We continue to do longer term rates. Some of them won't do them at all. You're seeing shifts and residue and long-term workouts of this current crisis that I think are going to be with us for many years to come yet. We see some banks establishing floors on short-term lending. We're not going to take this rate. I don't care what prime rate is. We're not going to take it below 5%. We're not going to take it below 4%. And you see some cutting back on the ag footprint entirely. Banks like National City or names like that, their problems are so profound that we've seen them really just exiting agriculture. We also see this phenomena right now. We've seen a lot of banks that have lending officers that are mature. They've been around 25, 35 years, and now they're retiring, and they're not replacing them with new ag loan officers. They're just choosing, that's where it's going to end right here. At the same time, though, there's an emergence, and I would say this. I'd say, and I give my hats off to private rural banks, smaller banks. You know what? They can wave their hats proudly. They did not get into trouble. They did not become Wachovia, Citigroup, or all the other names we've seen so much in the news. And there's a good, strong, independent rural banking system out there that still has great interest in agriculture, and they're going to be there. So hats off to them. Now here's a more positive slide. I didn't come in here with all negative slides. That looks like it though, doesn't it? This is an experience. What's important here is this relationship. This tracks a thing called the London Interbank Offered Rate. That's a short-term rate for borrowing money on a global perspective. It's bid on the moment in London, England by worldwide investors every day. Now, what was shocking to the U.S. market, if you'll look about where my little circle is out to the right, LIBOR spread shot up to a rate of 456 over Fed funds late last year, and that shocked everybody internationally. That meant everything just came to a stop. LIBOR is often known as a bank-to-bank rate. It sort of is reflective of how the credit markets are flowing. And when it shot up like that, that was a big signal. Whoa. Remember, did you ever read the story when that French bank discovered they owned so many U.S. mortgage-backed securities? Sacre bleu, what are we doing with all these American mortgages that aren't worth a flip? Everything stopped. Now, the good sign here is if you'll look to the far right, LIBOR's relationship has returned to a more stable, steady environment, and it is a good, positive signal that banks and others are lending again to one another. It's a good signal to our producers because for short-term borrowing, we tell them many times that a LIBOR index loan is probably going to be your lowest cost of credit over a long term. So right now today, if you were borrowing for operating expense for a livestock operation, if you were borrowing over $100,000 for that, that's the best rate you could get from us. The good news for operating money is that, look, at a year ago doesn't always go negative. For example, a year ago today, if you were borrowing short-term funds, 685 was the rate. Today it's 375. And our ads, I've got a copy of an ad running. It doesn't show up very well on the slide, but these are ads that are running in newspapers in our market today. It says something like, our doors are open for operating credit. We've not closed any doors on credit needs at all, and we don't intend to. And I showed you that LIBOR rate's even cheaper. But as we talk to producers, your choices are getting more complex. For anybody borrowing money and thinking ahead long term, the bull and the bear, they're not exactly stock market icons in this reference. The bull represents opportunity of a shorter term rate that can save money. The bear represents risk. What's going to happen out there on long-term money when the impact of the government borrowing all this money? You know, today you can borrow at a low rate on a short term. What's going to happen 3 years, 2 years from now, 5 years from now? What's going to be the cost of credit as the bill comes due for the Treasury and all this borrowing? What if the Chinese never come back to the American market to buy bonds again? That's why producers have to think, and everyone has to think about these two icons here. Now let me show you. This is the U.S. Treasury curve, and this is where we've come from, and this is what's happening. If you'll notice at the top there's the years 2005, 2006. And what's happened in the last months over time is the Federal Reserve has acted time and time again. And I think, in fact, 17 direct actions to knock short-term rates down to try to stimulate an economy, to the point that they're just out of bullets. They've driven it down so low they don't have anything left to do. That's why they're going to some of these extraordinary measures now, just throw the money out there, because they tried all their other levers. At the same time, the marketplace was beginning to talk, and the marketplace was saying that's what's driving the blue and the red line up. As people say, well, if you want me to borrow that money on a longer term, you're going to have to fork up a little bit of premium to get it. Now, the hump in those red and blue lines was caused by about a week ago when the new Treasury Secretary and administration decided to buy back $1 trillion worth of bonds, 10-year bonds. They were again trying to do it. Why? They're trying to see this low money to stimulate housing, thinking that's a attack point. And so now you're talking about they're into creating a big thing about 4.5% 30-year fixed rate home rates available today, and everybody's out there trying to refi again. But that may have longer term implications because, again, if they place all that debt and throw all that money out there, private equity or private capital people are going to have to pay more to raise money. This is where farm credit trades over Treasury debt. We're not the U.S. government. We can't issue debt like the U.S. government does. And so our investors say, well, you have to pay me a premium over U.S. Treasuries. We did not at Farm Credit get the 100% guaranteed backing when the federal government stepped in to protect Fannie Mae and Freddie Mac. They gave them an explicit guarantee of those bonds, saying as good as faith as the United States government. Well, nobody else has that, including me, including John Deere, including all of you out there. So I have to pay a premium over the cost to get money. And that's just what those lines represent. You can see as the term goes out, the 10-year, I have to pay a premium of almost 1.4% or 140 basis points over Treasuries. 8 or 9 months ago, I was paying 40. This is the Farm Credit real estate yield curve. If you came today to purchase a $1 million farm, I would lend you money from a variable cost of $335 to a 30-year fixed cost of over 7%. So there's 400 basis points in the yield curve. And that's what's causing the decision for people to borrow money. What do I do? What is my strategy? Do I play short? Do I play long? These are looking at some real numbers we're offering today, at least on 326. 25-year term, absolutely, I'll give it to you. Fixed rate contract, absolutely, I'll give it to you. Cost you $710. 5-year adjustable, cost you 5%, 210 basis points of savings. But what's going to happen in 5 years? And how are you thinking about shielding your operation from risk that might be out there? You can see you can get almost any kind of term and any kind of condition that you want. The differences in prices there represent prepayment terms and other things that work into. Now, this is not an advertisement, but I guess it is an advertisement because I'm talking to my farm producers, and I like to show them this. I monitor 130 banks every quarter to ask them what their rates for farm lending are, and the red line represents us, fortunately. We have a strategy in our business that we want to provide capital to farmers at a low-cost, lean, mean, operational level. So our 5-year rate on this day at 5.22, we led the market there. The other people up and down that line are all sorts of banks and others. We make no apologies for that. Sometimes people say, you guys must be predatory pricing. No, we can manage our operation and pay our people and do all these things because of our co-op structure, and we can offer money to farmers at a lower rate than many others. And that's what we intend to do, no apologies. This one shows a 15-year fixed rate. I'm in the middle there. And the reason I'm in the middle is I'm plotting my 15-year fixed rate against everybody as a whole, and all those players out to the side there, they contain either fees that you pay to get in on the loan or harsher conditions, something like a make-whole, yield maintenance, whatever, contracts that tie up that money for long term where you can't break them. I could offer you that kind of contract as well, and if you paid me the equivalent of some of their 1% fees, I'll bring that red line way down. You can see by this chart, you can get anything you want, any color you want. It's your choice. And that's what we tell producers. If you want to finance a farm at a 1-year contract on a 360 rate, you can certainly save money. But that's not the product I'm going to tell you to, that's not my recommendation, because I think that you've got to decide what's your, between risk and value or opportunity on interest rates, where do you come in? Things are volatile. Things can change, and the long-term picture can change appreciably. Now, as far as credit available to agriculture today, I think most players, in fact, we see plenty of people wanting to play in agriculture today. There's international firms like Rabobank, Wells Fargo has a healthy appetite, Bank of the West, Metropolitan, Prudential. I even saw the other day the Janus Fund wants to make loans to agriculture. Everybody's got money out there all of a sudden. They see agriculture as one of the bright spots, in a sense, for lending over the next few years. But we intend to offer a full line of products. We intend to offer our customers long-term opportunities that can avoid risk, but they have to decide what the premium for that is. We're very strong, and we're strong because farmers are strong right now. Farmers are operating from one of the best equity positions they have in many, many moons. Our strength reflects that. Our capital base is very strong. Why couldn't Fannie Mae and Freddie Mac have any standing power? Because the government said, oh, Fannie Mae and Freddie Mac, you only have to have 2 or 3% capital. Whoosh, that was gone overnight. They had no staying power. You know, a commercial bank operates on a 7% capital base. We're have the same regulation on us, 7%, but we choose to keep about 13 to 14% because we think, yes, rainy days do come along. We learned our lesson in the 1980s. It was a hard lesson today. Stress in some areas, particularly livestock, but at the same time, isn't it an interesting market? I've never seen the likes of how it's changed. I talked about that doubling of big farms, and the other gentleman talked about maybe a new model emerging. But we had a $20 million application for a dairy in Kentucky the other day. A whole new model, whole new scale of production coming about. And though we continue to say, well, we base our loans on character and credit and collateral on the 5 C's, well, I think you've talked a lot this morning about a C that's important for us as well. It's care. And we're asking more and more producers, because capital is at risk for everybody, what's your practices? What do you do about disposal? There's laws coming about in Kentucky about rendering and other things. They're going to have profound. We need to make sure we're working with producers who have a good stewardship, good practices, etc. And that's more of the credit equation. We ask more questions about that today than we ever did before. I'm sure all lenders will be doing that in the future, because it has not only a negative impact on the producer, but it also has a negative impact on the lender when things blow up, when somebody hasn't taken care of business as they should.